An Allianz Chief Economic Advisor, Mohamed El-Erian, on this as well. Mohamed, good to see you. Thanks so much for joining us.
Thank you, Maria.
What's your take on this? Is this a hindrance, this battle over Obamacare and the replacement plan, to the president's pro-growth agenda, including tax reform, which, of course, is what the markets have been rallying on?
Yeah, and you called it a battle. Battle lines are forming both within the Republican Party and more broadly. And the question is a political judgment. To what extent will President Trump use his political capital here as opposed to tax reform, infrastructure, which contributes directly and quickly to economic growth? And that's what the market is trying to understand. And the market is worried that too much political capital may be dissipated here.
Yeah, I mean, what about that? Because we have these expectations of a timeline where Obamacare replacement repeal is going to happen first, and then you've got tax reform after. Do you think the market believes that that will be, for example, 17 impact or 18 impact? Because Steven Mnuchin, the Treasury Secretary, said, don't expect a big impact in 2017, and yet we're still up. This market's up 14% from Election Day.
Well, the market is expecting that we see progress on tax reform in the summer, because that's what we have been told. Now, the impact may not be immediate, but it will bring forward a lot of private sector activity. Clarity on tax reform is an important contributor to economic activity. So there's expectations for details, for a clear timeline. And the judgment to be made is the sequencing of policies. Can you get all this through Congress? Because remember, we are transitioning away from central bank support for growth and towards genuine policies that promote long-term economic growth.
So is that the right move? I mean, we just heard from the ECB. They're leaving interest rates unchanged. Do you expect Mario Draghi to say, it's over, no more stimulus?
No, he won't say that. He'll want to keep his options open, but he will say the economy is looking better, growth is picking up, inflation is picking up, and he may, and I stress may, hint that this open-ended QE may be reviewed at the next meeting. It's going to be interesting to see how he does that. He has the French elections on his mind, and he has the Brexit clause on his mind. So he cannot go too far, but it'll be really interesting as to how he approaches this issue.
And what do you think this means for markets? Because all the markets are down this morning, obviously. I mean, of course, the stock market in the U.S. coming off of a record-setting week following President Trump's address of Congress. Do you think this rally can keep on going in the face of ECB reviewing this open-ended QE?
So we've come a long way quickly, right? We've surged since November. And now the market is saying, OK, I like the tone. I like what I'm hearing in terms of headlines about tax reform, infrastructure, about deregulation. But what about the details? And what the market is looking for is greater policy details. And the longer it takes for these details to emerge, the more pressure on the rally that has been pretty remarkable since November. Yeah,
it's been pretty remarkable. Would you put new money to work here? I know you were cautious going into election and the inauguration in terms of markets. The market has been strong. There's still a bid under this market.
Yeah, absolutely. I was cautious for a short-term reason and a long-term reason. The short-term reason proved to be wrong. And the short-term reason is I was worried about the protectionist rhetoric. As it turns out, the protectionist rhetoric has been very low and the pro-growth rhetoric has been high. Longer term, we are at a very delicate handoff where we've had artificial growth promoted by central bank policies, and we're looking to a handoff to genuine growth drivers. And that handoff, as I noted, is not clear as yet. So I would be cautious here. I would keep some dry powder. I think you'll have opportunities to pick up good names at cheaper prices.
Okay, so let's talk about the jobs report coming out tomorrow, Mohamed. What are you expecting? It feels like things are getting better. You just said growth is getting better. Economists are looking for the unemployment rate to tick down to 4.7% and 190,000 jobs to be added to the economy. Does that sound about right to you?
Yeah, that sounds right. I will also look at two other numbers, wage growth, which needs to go up, and the participation rate, which will signal how much slack remains in the labor market. Critically, I don't think tomorrow's report will derail a Fed hike next week. But if the report is very strong, and the ADP number suggested it could be, if it's very strong, then look for the Fed to signal a lot more about what's coming in the rest of the year. And I think we get at least, and I stress, at least 3 hikes this year.
Yeah, well, with the ADP numbers yesterday were pretty strong at 298,000, which of course caused a lot of people to say, oh yeah, I'm in on the 3 hikes next year. So you think we will get an interest rate increase next week then, Mohamed, when the Fed meets on the 15th?
I do, and it's been remarkable that in a few days the Fed has been able to take the implied market probability from 30% to 100%. It did this through a very calibrated sequencing of statements. It was helped by stronger data, and I think we definitely get a rate hike next week.
All right, so we get a rate hike next week. What does that mean for markets? I mean, does that jive with expectations, or do you think, so if rates go higher, will people say, uh-oh, you know, now there's more competition for stocks, let me sell, or will they say, well, this is a vote of confidence for the United States economy? So
far they're saying the latter, and that's why the increased probability has been priced in such an orderly fashion. So far the market is saying, you know what, this is good news. It means that the Fed sees what we see, which is higher economic growth and higher inflation. The question becomes the policy handoff. If you're going to take your foot off the accelerator on monetary policy stimulus, which you should, you want to press harder the accelerator on genuine contributors to growth. And that's why politics becomes so important.
Have you looked all around the world in terms of investment ideas? If you were allocating capital today, what would be your most preferred place? Is it the U.S., Europe, emerging markets, Asia? What looks best to you right now, Mohamed?
So I would be careful overall, but I would do a certain amount of rotation. For example, tech continues to lag in the U.S. There's opportunities there. Emerging markets, yes, they've come a long way, but there's still pockets of value. So I would be incredibly selective at this point, waiting to see how the political risk plays out.
All right, we'll be watching as well. Mohamed, good to speak with you as always. Thanks so much.
Thank you, Maria.
Mohamed El-Erian joining us there.